Welcome to Investing with IBD podcast. It's Justin Nielsen here, and it is November 15th, 2023, and we've got quite a show for you today. Joining me, as always, is Arusha Paris from O'Neill Global Advisors. He's a portfolio manager over there. How you doing, Arusha?
I'm doing well, Justin.
Okay, a little bit better of a market to talk about, so that's always exciting. And helping us with that is Charles Harris, who is also a portfolio manager over at O'Neill Global Advisors. So I feel a little outnumbered today, but Charles, so great to see you. Charles, of course, he and I sat next to each other back in, what was that, 2000? Yeah. Way back when. And I got to learn so much from him. I was just starting out, and he was about to become a portfolio manager, and he was running his own money and showing me what he was doing on the old ILX machine. And every now and then I'd hear him on the phone, and then I'd say, "Oh, look, there's Charles. I can see his volume spike right there." So
Wow.
that was fun stuff. So of course, Charles and I also worked on the Market School product together. Gosh, we did a lot of projects together. A lot of fun between.
We worked closely together for at least a decade.
Yeah, he was in Bill's office, Bill O'Neill's office, the founder of Investors Business Daily. I was right outside looking in sometimes, saying, "Gosh, looks like you guys are having fun in there." But great to have you on. Great to have you on the show, Charles. One of the things we're going to be talking about, I think, one of the favorite topics when you were at the master's classes. Anytime you've talked, I feel like you really hit the psychology part of trading so well. And you come at it from such a place of humility of like, hey, this is something we're all figuring out kind of together. And if I'm not mistaken, were you a psych major?
Yeah, I was actually a double major in psych. I mean, I started out math, computer science for 2 years, then decided I don't really like this.
Yeah, that South Campus part of UCLA was not not attractive for you. Yeah,
it was like a different world when I went from South Campus to North Campus.
Yeah, I hear you. I was also thinking of getting my Bachelor of Science for a little while, and then said, Bachelor of Arts sounds good. So, yeah. So let's get right into it and start with the market here. I feel like the market, there were all of these things we were asking of it, saying, well, the market's got to do this, the market's got to do this, the market's got to do this. And it seems like it's just ticking those off one by one. It's gotten above the 50-day moving average line. It's crossed the downtrend. It had a 3 waves down. It's now back above 14,000. Is it too good to be true, Charles?
I think that, we're all waiting for a pullback. Right. And like I was maybe looking at the 3 waves down following the, the internet bubble bursting and that bear market that followed. So, we bottomed there in October of 2002. We rallied up to the 200-day and then had the 3 waves down. And we had a nice move. What's that?
Are you talking about the 2003 precedents?
Yeah.
Or? Oh, okay.
Yeah.
Okay.
Yeah. And then we had the 3 waves down in 2003, and then we broke out and had a really nice sustained move. So I think, right in there. So we had this nice little 2-week window of consolidation before we went on that big run. And now, I think, and whenever I hear anyone on TV or even on IBD Live, it's like, oh, I'm going to wait for the pullback. We're going to get the pullback. And we should get a pullback. But I think when everyone's looking for a pullback, that's usually when you don't get a pullback. So I think, we are going to have a few bad days in here. And I have no idea what's going to happen. But what my feeling is that, we're going to get a little pullback. But I think it's going to be very short and sweet. And if you're not invested as yet, or if you're way underinvested, you're going to have to maybe take some action, or at least that's how I would handle it. But anything can happen. I mean, this has been a year where it's just been a lot of false starts. But I feel now with the inflation data being much more benign, and I think we feel pretty secure that the rate hike cycle's finished. And, and it's been a really tough 2 years. If you pull up a weekly or monthly on NASDAQ, I mean, a 2-year period of not hitting new highs. You have to go all the way back to the financial collapse in 2008 to have another period of that length of time before you've hit a new high. So it's been, it has really worn us out. It's really been a nice combination. It really hasn't been that nice, but it's been a combination of wearing us out just time-wise and scaring us out because the growth sector, and particularly speculative growth, like represented by the ARK funds, were devastated and decimated. So, those peaked 2.5 years ago. And you still have names like Shopify still off, over 70%. There's still like a lot of great stocks that are still, or at least former winners. I should say the ARK funds are down 73%. I'm not sure what Shopify is, but it's probably in that range. So yeah, I think that the market's been surprisingly strong these last few weeks, rallying up about 13% in 14 days, which is pretty strong without any pullback. I mean, it's been up almost every day. And I looked at for a number of precedents for that kind of action. And I had, and these I remember as we traded them back October 1998, following that little long-term capital blow up. And that was incredibly strong, right? I mean, it took off and it did not give you any opportunity to get in on a pullback for about 4 months. So, the market, and we've only gone up for 14 days. So you never know what the market can do. Wouldn't it be amazing if we were in this kind of period? And I had no clue what's going to happen, but we are entering, I think, a new innovation cycle. Just like we had the internet back in this time frame, we have AI this time around, and it does seem like this is something that's going to be truly profound and touch everything. And great bull cycles usually ride a wave of new innovation and technology and something really exciting, whether it's the internet or the advent of the PC. These kinds of secular shifts in technology usually coincide with these great runs. So I think the market can be a lot stronger than people think. Another in that same time frame, a year later, in October '99, the final thrust of the internet bubble also took off from the kind of that kind of tough market environment where kind of like that doesn't look, it looks pretty benign on the chart, but those, I don't know what it was, 4 months or so of
the summer of '99.
Yeah, where you kept hitting a new high and then pulling back. I mean, it was pretty brutal. But then when you finally took off, just look, the market was up almost every day, and it pretty much held the 10-day moving average. And if you were just waiting around for, I'll wait for a nice 2-week pullback, it just didn't happen for a few months. So, I don't know what I'm in, but I have these periods of time in my memory. And so I am afraid I'm not fully deployed.
Well, it's a little interesting that you're using 2003 as a precedent, which was the start of like a recovery out of the dot-com bubble. And you're also using as a precedent kind of the 98, 99, which was the end of a big move that we had for most of the 90s that preceded the dot-com bubble.
Yeah. And what I'm looking at is basically just periods of time when the I mean, we can find more, but just periods that I lived through that are still in my memory. It's like almost like my little like intuition is like, well, you know what, this can go a lot further than people think. Because I'm always looking to buy on a pullback, right? That's my style. But I do remember these periods of time when the market just kept running, and if you didn't get involved, you are left behind.
Yeah.
So, and I hear a lot of people out there who are, I think there's still a lot of wariness that this rally's for real. I don't think that sentiment is overly bullish, even though we've had such a huge move in such a short period of time. I just feel like there's still a lot of money on the sidelines, and people like, I don't know if I still believe it yet, and I don't know that we're not going to have a recession, and we don't know what Powell's going to say. He could just say, higher for longer, and that might, hit the market again. So I don't know. I'm feeling like there's a lot of people afraid to really get involved. And now that things are running away from us, that makes it even harder. And what usually happens in those cases, just human nature being what it is the market will keep going up until you just can't take it anymore. And you say, yeah, I just need to get in. And you get in, and then you're going to get a nice little pullback. So that's just how the market operates. It operates in a way to fool the the highest number of people. So that's
Charles,
that's what I'm looking at. Yeah.
So I think this is a perfect time to maybe bring up the market school, right? And the power trend, because we've had a pretty strong move over the last few weeks after this follow through day. And market school was designed to help us recognize, hey, when are you in some kind of unusual type of environment? And you quantified, you and Justin and Mike Webster quantified a number of rules to help you stay in and try to capture the most of a really powerful trend. So maybe, and Justin, I'll interview you and say, why don't you explain this? Maybe just go over the definition of a power trend, because we're starting to get a little close to it, right?
Yeah. I was going to say we should test Charles, because it's been 10 years. But in the pre-show, he was doing pretty good. I was impressed.
Well, it's funny because you mentioned, like, we'll talk about market school, and I thought you were joking. But I will say, I'm going to have Justin go over the explanation, because it's far too confusing, and it's been far too many years for me to remember all the ins and outs. But the beauty of the market school approach was that it takes all of these kind of feelings and moves them to the side and say, well, what's the market actually telling us? And again, this thrust off the 200-day has been really powerful. And the model is saying you should be fully involved. And it's been that way for at least a week, I think. Mm-hmm. So basically, market school said, okay, never mind what you think or what the headlines are, what the news items are. What is the market telling us? And the market's saying it's acting strong, and you should get involved. Yeah. And that was the whole point of doing this approach, was to really listen to what the market is telling us, and not what our kind of feelings and emotions are telling us. And so it's worked. And again, it's been telling us to get fully invested, and yet I think many investors are not fully invested. Mm-hmm. So anyway,
well, and I will say that one of the difficulties this time around has been this whole question of, the market school rules really just look at the market index itself, specifically the NASDAQ composite. And with so many people talking about the breadth issue, it's like, does that translate to what you should be doing with stocks? Because the NASDAQ has been acting very differently from most of the stocks out there. And I mean, if you look at RSP, we were talking about how the equal weighted S&P 500 ETF, I mean, that looked so different. At least now it's back above its 50-day moving average line, and, right there at its 200-day line. But that was a big question mark. We don't look at breadth. We don't look at, individual stocks and leaders and everything like that for the market school rules. We're just looking at the index itself. But to get to the question, in terms of power trend, we do have a number of the factors in place now, and we're just waiting for the final piece of the puzzle. So we have the 21 above the 50-day moving average line. We just need that to be 5 days now. Tuesday was the first day where it was above that. We have the 50-day moving average line in an uptrend. This was actually one of the things that Charles came up with. He was, really interested in kind of seeing that as a proof point that we were truly that strong. Although I will say Mike Webster was bringing up the question of whether or not maybe a EMA, an exponential moving average, would be a little bit quicker in getting that. So if you want to get the band back together, Charles, maybe we test that out.
Let's do it.
We also got one of the other elements today. We have 10 days where the low of the index has been above the 21-day moving average line. That's the green line on Arusha's chart here. So we've got that in play. So really the final element here is the 5 days of the 21 above the 50-day, and this is day 2. So we could see that as early as Monday for the power trend to be back on.
And then
just to pivot on what you said, Justin, with regard to, it has been tricky because not only has the breadth only really started to improve in, I think in the last few days. I mean, I think there are a lot of stocks now to pick from.
Right.
But yeah, breadth has been terrible up until very recently. And also it's been kind of strange because volume hasn't been that huge on many of the individual stocks that you think would have really nice volume. So like, we always talk about NVIDIA, but NVIDIA, I think that has an AD rating of an E.
Right. Yeah.
I mean, is that true?
That's true.
Yeah,
Yep.
true.
Yeah. So I mean, like, that's not normal. That's not what you would expect, So we've had this really light volume kind of rebound off the lows, and that's kind of also made me a bit skeptical or a little bit scared because normally you want to see some volume on the right side, and as you're approaching the high, before maybe you get a nice little handle, and there just haven't been many elements of strength in terms of volume.
Yeah.
So,
you would expect that over the summer, but once we got past Labor Day, it's like, hey, where is it?
Yeah,
where'd it go?
Really odd. And so when we used to do the workshops, it was I did the sell signals, and low volume rallies were an indication of maybe institutions aren't involved. And even though we know that institutions are involved, but it's not showing up in the volume. So it's been a strange market. It has been. It hasn't been easy.
Getting back to the power trend. When you get into power trend, what is the significance of that, and what are you supposed to do? Right? Just maybe explain that process.
Are you talking to me?
That was for you, Charles. Okay. I mean, I'll remind Charles of what we talked about 10, 12, 13 years ago, whatever it was now. I mean, certainly one of the things was there were those times where you wanted to kind of slow down your selling, and so we implemented a few things, and it's funny because there were these time periods that we'd look at, and you could have these moments where you were getting sell signals, but you would come up so much, and so it's like, well, you were still kind of holding a lot of the gains you had, and maybe you were getting distribution, maybe you're getting these things, but the idea was that if you had these massive gains on your stocks and you'd made all this progress, you probably didn't want to completely get out. So we implemented things like having a floor. We implemented things like having a little bit of a cushion to slow down your selling before you really, started, having those sell signals be acted upon. But at the end of the day, we also had in there kind of, look, if you got a distribution cluster, you've got to do some, take some action because of distribution piling up. Or if you're below the 50-day moving average line, well, that's, these are two things that would put that power trend under pressure. And then of course, the final signal, which was usually very, very late, was that the 21-day would get back below the 50-day moving average line. That was usually, we were usually long gone by that time in terms of our exposure. But any final thoughts on that, Charles?
No, one thing that we never got around to implementing that if we kept doing it, we would have certainly is using margin in
Yeah.
our model. And I
Or
think,
shorting.
or shorting, right.
Yeah.
But in terms of the power trend, when things are that favorable technically, that would typically be a time when you could implement margin and just be more aggressive, because it's really telling you that the market's, technically acting, in a very strong way. And if you have the breadth and lots of, choices, in terms of stocks, that's when you can kind of be comfortable to push it a bit.
Yeah. In some ways, we often use the analogy of when you're playing blackjack, and if you're counting cards and you've got a favorable deck, with the count in your favor, where it's time to take advantage if you can. So let's go ahead and take a pause real quick. We'll take a break, and when we come back, we're going to have Charles talk a little bit more about the idea of psychology, one of the most popular topics that Charles talks about in his sessions. Stay tuned. We'll be right back.
Trading Apple? Sometimes you get the bear. Sometimes it gets you. Single stock daily leveraged and inverse ETFs from Direction. Before investing, carefully consider a fund's objectives, risk, charges, and expenses contained in the prospectus at Direction.com. Read carefully.
Welcome back to Investing with IBD podcast. It's Justin Nielsen here, along with Arusha Paris and my good friend, Charles Harris. Both of those guys are portfolio managers over at O'Neill Global Advisors. So again, we've got two O'Neill portfolio managers in the house. Charles, of course, has been doing this a lot longer. 23 years now for you? A little bit over that. I
started managing money in June of 2000. So
June of 2000, yeah. So you just had your 23rd year, and again, I got to watch you in action. I mean, after you were having some of the best years ever, 1,000% year was that in '99. I mean, that's how you basically got Bill's attention to become a portfolio manager. Like, he just said, "I want a piece of this," and you've had some phenomenal years in which you've just had these mind-boggling, triple-digit gains in a year, and you've gotten back to back where it's compounded out to just again astronomical things. But you've also had the tough years, the times where things haven't gone right for you. You get a string of losses, and that can be really tough on your psychology. So how have you handled it, and what have you learned from the process?
Thanks for reminding me, Justin. No, it's tough. My career has been very much a roller coaster. I've been pretty open about it. And particularly, really, I'm talking about my personal account, not the firm account, because we don't do that at O'Neill, the roller coaster. We have a much more upward trajectory. And but with my personal account, I think where I could say I have a weakness, it's in my risk control. I get, I can go on these huge runs, and I'm very slow to come to terms when I'm no longer hot. And I do have a tendency to trade very aggressively. So, I talk about in the workshops and, when I do the trading psychology section, that overconcentration and overleverage are the two elements of blow-ups. Like, you need both of them. And I do both of them. And so I've had quite a few blow-ups in my career. And excuse me. And I actually, I've given a couple of talks about this that are on YouTube. The first one was back in 2019 at the master's course, where I talk about really about a 3.5-4 year tailspin, where I blew up, my personal accounts pretty much, down like 85%. And that really took its toll in many ways, including, it wasn't the reason, but it was definitely a participating factor in the fact that I'm divorced. So I'm also best friends with my ex-wife, so which is nice. But no, but it really, that financial stress and just the emotional toll it takes when you're in a major losing streak and you just can't seem to get out of it. It just takes its toll on so many levels. So I gave
Charles, let me just interrupt that. So, I mean, essentially, that sounds like you're in the middle of a downward spiral, right there. I mean, is there some kind of trigger to say that I'm back? I'm just in this downward spiral. Nothing's going wrong, where you just have to walk away or anything like that?
well, that's the problem. Walking away is what you should do, and basically stopping trading, coming to terms that you're just not on, and taking a break. But I never take a break. That's the problem. In fact, I don't think I've I've almost never taken a vacation. I mean, it's really it's tiring after a while. But I do have this kind of bullish bent in me, and I have a lot of confidence. And when things are working, and I just think they're not going to stop. And I think, oh my God, I'm a genius. Well, I'm up 50-fold. Like, I'm going to be up 100-fold.
Yeah.
And so, all the things I talk about in the trading psychology section of the master's workshop, and all those rules, and the tendency for people to extrapolate short-term moves and to get overextended and not to set a line in the sand where you're going to begin to raise cash. All these things, all these rules and ways of looking at things are so critical. But honestly, I violated every single one of them in these blow-up periods. And so, what I've talked about in these kind of personal journey presentations I've given, there's two of them. I just gave back at the first couple of days of September to a joint IBD meetup group up in San Francisco. And I talked about my latest blow up, and which was truly my most profound blow up in terms of money and in terms of percentage. Like I thought it couldn't be worse than 2014 through 17, but
you thought 87% was as bad as it would get,
yeah,
huh?
I thought, wow, that was pretty bad. But this is like literally, this was really a blow up. And so in my margin account, thankfully, I'm not allowed to margin all my accounts, so I've survived in some of my accounts. But this one was truly profound. And so what I've talked about is that it's not enough to know what rules you're breaking, because you can do a post analysis and discover where you're going wrong. And if you do a post analysis when you're in the midst of a losing streak, you'll realize that you're trading when the general market's not in your favor. You'll realize that you're not cutting losses. You'll realize that maybe you're buying extended. You'll see all the things that you're doing that are wrong. And you go, okay, well, that's pretty simple. I know what I'm doing wrong. But it's not enough, because for me, I know that what I'm doing wrong. It's just I keep doing it. So you have to go a little deeper, or a lot deeper actually, and discover, well, why am I breaking these rules? And why do I keep repeating this cycle of making a great deal of money and then losing a great deal of money? And for me, and I've been in therapy now for a number of years, not just over this, but it's all related, whether you're talking about relationship or just your feeling of worthiness or the market. Everything is kind of the same origin in a way. And for me, I can't go in great detail in this short segment here, but I go into great detail in the presentations that are on YouTube if anyone wants to see. But really, for me, what it's came down to is this feeling of kind of worthiness or a lack of worthiness, and this like a deficit there. And for me, more money meant more value. And so it was really get this insatiable appetite to feel good inside, and it couldn't be satisfied. So no matter how much money I made, I just kept putting the bar higher. Like it was never enough. And in this last run that I had, so I actually was, people always ask, so what happened when you blew up your account, and did that first presentation, like lost 87% of your money? Were you able to come back? And I did. And I thought it might take 10 years to come back, or at least. But I came back. The COVID, as bad as it was good for traders who knew
Good for our style.
For our style and where to deploy those funds. And of course I got on board on Tesla, and I made back all that money and then much, much, much more in a 2-year period. I was up almost 50-fold, which is, I've never had a run like that back to back, that compounded to those types of gains. And then I managed to lose a great deal of it. And in my margin account, literally blow it up just because I was so concentrated and so, playing with a lot of leverage.
Mm-hmm.
And so it was really, when I was making that money, it was just like an itch I couldn't scratch. It's just like I just kept playing. Like I wasn't sober enough to kind of look at my account and say, wow, I just made a lot of money. I don't have to work anymore. I'm going to take half of it out, put it in the bank, and play with the other half. Like that would have been the sensible thing to do.
Well,
And
Charles,
I know that's something that you were doing before, with a number of the runs that you went on before. I know that was something that you typically did.
Yeah, well, I always am selling into strength, right? But the thing is, I always redeploy on a pullback. And sometimes these pullbacks turn into major bear markets. And rather than saying, oh my God, this is no longer a pullback within an uptrend, this is now a broken stock or a broken market, I just keep thinking, yeah, but I know this stock. I know this. This is my long-term one. And I honestly, that's what I did with Tesla. Was I said, I'm holding this stock for 10 years. I don't care what happens. I'm holding it. That's how much I believe in it. And I still have that belief. But when you're concentrated and on margin and a stock falls 75%, it doesn't matter. You're going to go broke. That's just how the math works. So, if had I not gotten margin calls, I surely would have lost that entire account because, I had to raise funds. I was forced to raise funds. I didn't want to, but I had to.
Charles, I mean, it almost seems like, when things were going so well and you're talking about the not being worthy of it, that it's almost like a self-sabotage, right? Where
it's definitely an element of it, Arusha, that it is self-sabotage on many levels of feeling like, there's two things you can do when you don't feel like you deserve your performance or your wealth. You either maybe get some therapy and change your mindset and say, you know what, I do deserve it. I work hard and I'm a good person and I've, talented in this one little way and I deserve it. And then there's the second way is like not believing you deserve it and then sabotaging yourself and taking whatever actions you do, even if they're kind of unconscious, to basically put your external environment back in line with how you feel internally, which is what happened to me. Basically, I said, you know what, I don't deserve this money. And then I lost the money. So, one thing that is interesting that we're doing this segment today is I had I met with my therapist yesterday and we were talking about the market the whole time. And I was telling her, like, so yesterday, right, was a big day in the market, right?
Yeah.
And I had a big day in the market, in my personal account, a big percentage day. And I was telling her how I'm just a little bummed because the amount of money I made off my new base was whatever it was. Let's just say I made 40 grand or something, which is like, that's a lot of money. Like most people would say, well, that's a lot of money. Good job.
Per day's work. Yeah.
A day's work. It easily would have been 7 figures 2 years ago.
Mhm.
And so I'm used to playing with bigger numbers. So it's kind of like, I was just bummed.
Mhm.
I was like, wow, this is a bummer. And so one thing we talked about, which is really important, I think this is a message to the to the audience about how to protect yourself from blowing up and really messing up badly, is really implementing some level of self-care, where, like, for me, I'm most comfortable when I have a lot of money in the bank. That kind of allows me to take on the risk I take on in the market, because I know, like, worst comes to worst, I'm going to be okay. I've got money. But over this last period, my cushion is much smaller, in terms of savings. It's just, it isn't what it was, because I kept taking money and putting in the market. So I've implemented this approach of taking out 25% of my profits every time I reach a certain level. And what my therapist, we were talking yesterday, and I said, it's going to take me a long time to get back to where I was. And she said, where you were in terms of money? And I said, yeah. And she said, yeah, but when you had all that money, you weren't happy. It wasn't enough.
Well,
It's never been enough for you. Like, what do you think you can do different? And what will be different this time? And I said, well, I think what's going to be different this time is that I'm aware of the fact that I need to take care of myself and pull money out of the market and not put it all at risk, because, I now have this awareness of, the tendencies that I have, and the fact that I don't need to have, like, I do have this kind of new sense of worthiness, that I don't need to prove it, and I don't need to have an unlimited amount of money. And so anyway, what she kind of asked me to maybe try doing, which I just started today, by the way, is rather than wait till you hit a certain level to take money out of the market, every time I have an up day, I'm going to take 25% of those profits and just move it into savings. And she said, try it for 3 months and see how you feel. Like, do you feel safer? Do you feel like you're taking care of yourself? Because one of the things I told her was, I feel uncomfortable not having enough money in the bank. So just today, I sold a teeny bit of my stocks, and I wired money out of the market into my savings, and that's where it's going to stay. And I'm still playing with 75% of, I still have my base and 75% of the profits I'm making. So really the realization is, kind of like, how did she say it? She said, this is how you parent yourself. Like, it's uncomfortable for me not to be fully in
mhm.
leveraging everything I've got and going for it. Like, that's my default. My default is just putting everything I can in the market, especially when we're in this kind of market, and building my wealth as quickly as I can. And this is a different Charles now, in a way, because by taking money out every time I'm making money, I'm on, mathematically, it's going to take me longer to recover.
Right.
I'm going to make less money, assuming that I'm trading well, but I'm also taking care of myself and building up, kind of replenishing my savings and just taking care of myself. So, I'm in less of a rush than I was, and I'm dealing with that uncomfortable feeling of, I want it now. I want
Mhm.
more. And saying, you know what? You can't have more now, but you're going to take care of yourself. You're going to move money into savings, and you're going to take care of yourself in that way. And you still have 3/4 of your profits on top of your base to play with. So that's what I'm doing. I'm going to do it for 3 months and see how it makes me feel. Like, so far, it actually feels good.
Yeah.
Only been a day, but and so that's it. But the presentation I give, it's an hour presentation, the last one, which goes into quite a great deal of detail, just into my life a little bit, and maybe why I am the way I am. And but anyway, it's it's dealing with your demons, and it is really what it takes to keep it. There's many people can make it in the market, but keeping it is a different story. And so, and for me, I've always been very black or white. Like I'm all in, all out. All good, all bad. And this is really a way of tempering that and saying, you know what, I'm going to take a little bit out and put it into savings and play with the rest and just keep doing that. And I think that is I think it's also going to be in a way kind of, this is what I'm looking for, Justin, where I'm, by doing this process, it's going to kind of build on itself.
Yeah.
And
Self-fulfilling,
kind of be a virtuous cycle of feeling better and safer as I'm progressing. So
and making better decisions. That's
Well,
great.
yeah, and Justin, before you ask your last question, I just want to say, so because Charles and I are on daily meetings every morning, we usually keep Charles to the end to make his comments about the market because he's always the optimist, he's always the bull, and it's very helpful, especially the last few months when I get bearish really quickly. I'm like, okay, this is never going to go up, but we always have Charles there to remind us, and he's always looking at the positive side of, and so it's very, very powerful because in the end, the markets do have that long bias. So yeah, it's always great to have Charles go at the end to just remind us, hey, we're close to a fall day, stocks are setting up, and it helps shift all of our mindsets.
Yeah. And one other thing I wanted to ask you about, Charles, is how you've been handling these accounts differently. You talked about your margin account, and certainly overconcentration plus margin can equal great success or great disaster, right? It's you have to be very careful with that. But your firm account handled very differently. Certainly, there's an accountability there. Other people are watching, and you can't just you have to justify your actions to a certain degree. With the Roth account, margin's just not available. You can't do it. That's not something that you can do in a Roth account. So maybe talk about the difference. And I also should mention that, I mean, I remember how your ex-wife at times would kind of be there to build you up after you had kind of a rough time, and hey, you can do it, you've done it before, you can come back from this. So there's all these different levels of the outside kind of influence too. Can you talk a little bit about how that plays into it?
Yeah, when I first started trading and I first had my early success and I had my early kind of blow ups or pretty significant drawdowns, I wasn't sure whether had just been lucky or if I actually can be good at this. And early on, I thought I was probably just lucky. I mean, and a lot of it had to do with this. The general market was so favorable in the late 90s that we could just get away with a lot.
Yeah.
And everyone seemed to make a lot of money in that time frame. I mean, you didn't have to be a trader. You can just, open up the newspaper, throw a dart, buy a stock, and you made money. But over the years, you build a certain confidence up that, wow, yeah, I've blown up or I've had some pretty significant drawdowns. I need to fix this, but I always come back. So deep down, I have this kind of like inner confidence now that has happened so many times that I know I can make money in a good market, and I'll make way more than my share when conditions are right. I just need to fix the drawdowns. But yeah, I mean, with regard to how I trade the accounts differently, I would never trade someone else's account, that I have a fiduciary duty to, the way I trade my account. I take on a lot more risk in a way that my own account is really almost more a personal reflection of me. And because I have had to deal with, I've dealt with these issues of value and worthiness, that's kind of how I prove myself. More money means more value, means more worthiness. And I don't treat the other accounts that certainly any accounts that I trade for other people don't, that doesn't represent me. That's my job. And I'm trying to protect them and to make them as much money as I can and be responsible about it. So somehow it is just a different way of looking at things. And of course you are assessed and there are people looking over your shoulder. So you can't just go in and violate your rules. So that's a big difference there between trading for other people and trading for yourself. But that's not an excuse though. I mean, that's just what can happen though is, when there's no one looking over your shoulder, it's possible if you're not aware, to really mess up. So there's that. And then with regard to the Roth account, just the fact that it's not a margin, you can only do so much damage. I don't really trade them that much differently, but the Roth account is a much slower way of trading for me. And the margin account is almost like, I just go for it. I'm just aggressive. I mean, I'm aggressive in all my accounts, but I'm ultra aggressive on the margin account because you can just make so much money trading on leverage. And so, anyway,
it's fun when it works, right? But you know what? Not to put on the therapist chair here, but I think it's interesting that you said for the accounts when you're trading for other people, how you feel like you have to protect them. So maybe you have to do that for yourself too.
Well, yeah,
learn to protect yourself.
Yeah, that's a great point, and that's what I think I'm talking about now with regard to like self-care and pulling money out and putting into savings. Is that is a way of protecting yourself.
Yeah, absolutely.
And so that is what I'm doing finally for myself after all of these years. Wow.
Right. The parenting yourself, delaying gratification a little bit, for that extra protection and savings. But great stuff, Charles. Really appreciate you sharing your story. Hopefully it's something that a lot of our listeners can learn from. And, it's a reminder that no matter how good you get, you always have to be aware of these pitfalls in the game of trading. So stay tuned. We'll be right back. And Charles is going to talk to us about some of the stocks on his radar. We'll be right back.
Trading Tesla, sometimes you get the bear. Sometimes it gets you. Single stock daily leveraged and inverse ETFs from Direction. Before investing, carefully consider a fund's objectives, risk, charges, and expenses contained in the prospectus at Direction.com. Read carefully.
Welcome back to Investing with IBD. It's Justin Nielsen here, along with Arusha Paris and Charles Harris, both portfolio managers at O'Neill Global Advisors. So great to have their insights. We get Arusha all the time, but it's always great to have Arusha, but it's even more special to have Charles here. So Charles covered a lot of great stuff, and he kept on mentioning the YouTube. There's two actually Trader's Journey YouTube things to watch. So if you just go into YouTube and put in Trader's Journey, Charles Harris, you're going to get both of those showing up. So definitely worth checking those out to kind of get the full story, all the emotional ups and downs of the whole journey. You're just getting a little taste of it here. But let's get into stocks, and we can also start with at Duolingo. The Duolingo here, it's had this massive move last week, and it's consolidated a little bit, but what is it that you like about this stock here, Charles?
So I do have a small position in it. I got in a bit late, but the way I'm kind of handling this, the current market and where I'm positioning is I'm kind of bifurcating my approach between stocks that are breaking out to new highs, and particularly, in a beginning of a new bull market, and hopefully this is the beginning of something that's sustainable. IPOs are really where there's a lot of potential for big moves. So this is a relatively new issue. It it was again brought down with the market, but the numbers are good. They're expanding their offerings from just languages to, I think, to math now, and just different areas, educational areas.
Yeah, they just added music as well.
Music. And I actually was using it in Spanish, but I know you said you had a 400 days straight on Duolingo.
398. I exaggerated a
398.
little bit. Yeah.
I think I lasted 3 or 4 weeks, and then I got tired, and then they started sending me these like really sad faces. Like, what happened?
Yeah.
So yeah, I ended with "Hola, cómo estás?" and I didn't get much further. But
Okay. Well,
I'm
hey,
gonna go back.
that'll get you pretty far. At least you're friendly.
I'm gonna go back. But the volume, huge volume gap up on earnings. And so it was extended immediately. And sometimes it's really hard to get into stocks that gap up like that. If you kind of miss a pivot, and it's inherently more risky to buy a gap up, because how do you know when you're wrong?
Mhm.
So the way I handle these, and the way I handle this, is I did get involved on the gap up, didn't get the greatest prices, but it was just a very small position. So it's kind of a pilot position, and I bought more today. So, and I plan what I would like to do is try to buy on the 10-day moving average, which is, probably down another 5% or something. So, we don't know what's going to happen to it, or if it's even going to work. But again, these are the types of stocks that have great potential at the beginning of a new bull market. IPO stocks, there's no overhead. This is a new high ground, basically, and they can have tremendous runs. In fact, I have a whole notebook of stock, gap up stocks and how they behave. And, the first 7 to 10 weeks of a new run like this, if conditions are right, stocks can easily run 30-40% from the close of the breakout, from the gap up. So, no clue what's going to happen, but this is one of the stocks I'm trading and looking to kind of fill out a position on a pullback. Because again, you don't want to just buy when the stocks are, way extended. You are opening yourself up to a lot of risk.
So Charles, so right now you made a small position on the gap up day. Did you make another little small position today on the pullback, or a little bit?
Yes.
Okay,
Yes.
and then you're going to wait for it to pull back to the
I'm
10-day.
Ideally, I would love to kind of buy a bigger chunk on the 10-day moving average
and look for maybe an upside reversal or something like that.
Yeah, and if I got an upside reversal, maybe a shakeout under the 10-day with an upside reversal, I would get pretty aggressive. And that's just how I would handle it.
Yep.
Yeah. Let's go ahead and shift gears a little bit to the housing sector, and we can take a look at Toll Brothers. A lot of the housing stocks look the same, and this was a move earlier in the year that had some people scratching their heads with interest rates getting so high, mortgage rates getting so high. Why were the home builders doing well? And they corrected and got support at the 40-week moving average line, and here they are back. Toll Brothers at new highs, and this is actually, I know that you played the housing sector really well a little bit over a decade ago. And you had some experience just with your job before trading, kind of understanding the real estate market. So what's your assessment of these right now?
Yeah, so I guess because I did have a big play in housing way back when, you always seem to come back to the things that you were able to do well in the past. So I'm always kind of looking at housing. If you look at and normally I trade tech stocks. I mean, most of the stocks I trade are technology related or biotech or very growthy types of things. Some retail, maybe. Housing moves, is much more cyclical, and they can go on large extended runs, but generally they don't move like growth stocks. But if you kind of get the timing right, you can do really well in them. There's been an undersupply of new homes for really since the last housing crisis, back in the mid 90s. Builders never really replenished in the way that they normally do. Usually housing is a very much a boom and bust sector, but ever since the financial crisis, actually before is it the mid 90s? No, maybe I'm talking about 2007, 2008. Yeah, ever since that time period, they weren't building the way they used to. They used to really become much more speculative, buy a bunch of land, build a bunch of houses on spec, and at the top of the cycle, they'd be left with a ton of homes they can't sell, and and the stocks would crash. So they kind of got religion back after the housing crisis, and just never built the way they did. So there's really a supply demand imbalance for housing, and even with these elevated interest rates, there's just not enough homes for people to move into, and so we have strong supply demand factors involved here, and now we have rates that have probably peaked for good and maybe on the way down. So interest rates, housing stocks are very, very sensitive to interest rates. And now if they're moving in the right direction, these can maybe go on another run. And you can see how powerful the advance has been just over the last 3 weeks. Like if you pull the daily back up, just gap up after gap up off the 200-day. And that's a super strong looking chart. So
Yeah, not even earnings. No earnings reactions here. It's just that's pretty
right.
remarkable.
And they all look like this. They all look like
Yeah.
this. But there's a lot of RS line at new highs. Stock's been under accumulation. Really solid volume coming off the bottom. So this is an area where I'm looking for a pullback, because this is literally straight up off the bottom. But if we can get a pullback, and even if the market doesn't have an extended pullback, like I think we're all waiting for, it doesn't mean that stocks that have had a move like this can't pull back for a week or two and give you a low risk entry point. So you remember back that in the day, Justin, when Netflix moved right up off the bottom, rested for a week or two, and then began a long sustained move. I know we used to show that one, preview that one in the workshops. So housing's another area that I think is, there's a lot of potential, and not that we focus on PEs too often, but the PE ratios in all these housing stocks are between like 5 and 7. So I can't read. What's it say there?
6. It's at 6 right now.
Okay, there you go. So, I almost feel like this is just not a lot of risk. I mean, they're making money. Their profit margins are strong, even though they've been compressed recently because, or coming down because, they've got to incentivize people by buying down the interest rates and so forth. That's going to probably end, and I think profit margins can maybe reaccelerate. So I like housing. And another, do you want to move on?
Well, did you want to just kind of finish that thought?
Yeah, no, that's it. Just
Okay.
I think that housing, I think this, again, the combination of the interest rate environment becoming more favorable and the supply demand characteristics of the sector both bode well for housing. So I think that's could be a really good area. And then one thing, the way I'm approaching this market is kind of bifurcating between these stocks that are breaking out to new highs. So we just showed the Toll Brothers, and DHI is another one. And then we showed the Duolingo. So again, those are traditional stocks at new highs that, kind of an O'Neill type approach. And then the other place where I'm focusing on is in turnaround stocks that may have a lot of overhead supply, like a Shopify is a stock I'm involved in that is still well off its highs of a few years ago, but it's those highs are now long enough ago that I think the overhead supply is probably not going to be as is important and difficult to break through. And again, they reported a really nice earnings number. It's, they make money, and if you pull up the daily chart, that really huge gap up on earnings off the bottom, and it's just extending those gains with the market. So it's obviously extended on a short-term basis, but if you were to draw a line over the declining tops, it's finally moved above those recently, and I think that was an ideal time to get in, even though it looked extended.
Yeah.
This is, I think, a stock you can begin a position in and hope for a pullback.
Right.
And that's the way I'm treating these. Is I'm kind of, I want to be careful not to just buy extended, because I've been burned so many times. But this market it is feeling like you can kind of get away with that a bit, and you might be forced to. Because again, the market typically doesn't act the way everyone wants it to. And so again, I think there's a lot of money on the sidelines waiting for that nice, easy pullback. And it might be more of a news related thing, or just a really bad opening or something where you have to start to get involved. So normally I have a rule that the first day down, you never want to buy, because it's very rare for a stock to have a 1-day pullback.
Right.
But like today in Duolingo, it's the first day, but I bought small, and I put some limit orders in below the market, and maybe I get hit, maybe I don't. So that's how.
Yeah, I just want to
this market.
quickly point out here in the ownership block, you can see like Contrafund has really increased,
In a
gone
big
from
way.
0.8 to 2 million in the last quarter. JP Morgan's jumped from 10 to 14. So you are starting to get an increase in some of the institutional sponsorship from the IBD Mutual Fund Index.
Yeah.
And you look at that weekly chart, and we have this, kind of black line on the weekly chart that a lot of people don't know where that comes from, and it's really an 18-month line. And Bill a lot of times would say that once you get to 18 months, the overhead supply becomes less relevant. I wouldn't necessarily say it's irrelevant, but less relevant. And I remember him originally saying that with Yahoo.com back in 2003. It was coming out of a perfect cup with handle on the follow-through day on March 17th. And yes, it did have this overhead supply that it was looking at, but it was getting old. And, to your point, Charles, I mean, this was down 87% off of its high. And it's still off 60% from its high. So it's certainly, not our typical, but I mean, it's almost up 200% from its bottom. So it's moved quite a bit already. So.
Yeah, and there are a lot of stocks like this, because the growth stocks and the more speculative growth stocks, particularly the ones that were benefiting during COVID. So Shopify, being a internet retail stock, benefited during that time frame. They really got massacred. So again, down 80 to 90%, a lot of stocks. And they don't, this is, other than Amazon, one of the really a true leader, a stock that's proven in the past that it can make a major run.
Yeah.
And this is again the other company in that space. So I don't know, how high it can go at this point, but it's still a high PE stock. But it's these are the areas I kind of want to be involved in, the traditional O'Neill growthier type sectors.
Yeah.
And so again, I'm looking at new merchandise and then kind of old merchandise. I would call this like a fallen angel.
Yeah.
That can really sort itself.
But to be clear, this is very different from, some of those COVID era. I mean, you look at Zoom, ZM, that's still, that hasn't made it 200% off its low. DocuSign, Peloton, some of these high flyers, the fact that Arusha bought a Peloton was not enough to save it. So
they're much cheaper now too.
right. Well, hey Charles, it's always great having you on the show. We really appreciate you sharing your story and sharing your thoughts on a lot of these stocks. I think it gives our listeners a lot to think of. Again, for folks that want to catch his YouTube talk, The Trader's Journey, if you just go Trader's Journey Charles Harris, or you can go to @CharlesHarris at YouTube. And are you active on Twitter? I know you sometimes dabble a little bit.
I dabble a bit. I mean, I should post more often, but yeah, I'm on there every so often.
Okay, so that's another place that people can check you out. What is that? That's Chaz. What is your Twitter handle?
Harris.
Hold on, let me
Chaz Harris. CHAS.
Yeah,
Harris.
Chaz Harris. Isn't
1025.
1025, right?
Yeah. So okay, wanted to make sure. So that's definitely another place that people can kind of follow along with some of your thoughts. And again, great having you, buddy.
Really appreciate it. Like to do it in the future. I always love to see you guys.
Well,
Definitely.
That's not a problem. You're going to regret saying that. We'll have you on. You're going to be the new Arusha, so we'll have you on every week. Okay, that's going to wrap it up for this show. Thank you so much for watching, and please join us next week when we're going to have David Saito Chung, the Hat Man, back on the show, sharing some thoughts with us. And we're going to do it a little bit early next week because it is the Thanksgiving holiday. So you can expect that to drop on Wednesday instead of Thursday. We're going to tape it a little bit early for you. So thanks a lot for watching. We'll see you next time.